Good morning, everyone. Hope you all are doing good and safe at home. So, you remember the last video of mine about the moratorium? On this video, I told about I went to a bank for my educational loan for my further studies. Okay, so on the loans, I went to a bank. I definitely, you think that I'm a stranger from bank and I don't have an account on this bank. So, how a bank can provide a loan, educational loan to me? So on this video, I will tell about all these things and the term about the mortgage. So I just want to request you to stay till the end. So the story will start from here. I went to a bank and approached for a bank. Sir, I just want a loan. Bank asked me, you have an account in our bank? I said, no, I don't have an account, though my parents have an account on this bank. Okay, and asked me, okay, that's alright, that's good, and we can provide a loan facility to you, provided you have to keep something, and we have the right on such things. Okay, so what is the term called? Whatever I discussed, that's called a mortgage. Okay, so in order to get a loan from a bank, the bank have to keep something in case you are default or I default. The bank has to take back all the things and has the right on all the things to sold and try to and sold all the things and take back all the money from the markets. Okay, so whatever the things that I have discussed is all about the mortgage. The mortgage is the term, like it's basically a immovable property. So if you think about immovable property, so what is the things comes into mind? Definitely your home, right? Your house, your properties, whatever the things you have in your room, home. So that's called an immovable property. So that's I kept as a mortgage. Bank has to keep on the basis of that. Bank is providing loans to me. Okay, so what do you think about a mortgage? What is the meaning of a mortgage? Mortgage is nothing. It's basically a right or a charge against your loans for in case in your default, and bank has the right or bank has the interest to take back all the thing and sold in the open market in case you default. Okay, so that's called a mortgage. Okay, so if you think about mortgage, I told you just now that your home, your house is one one example of a mortgage. Okay, so where if you default, definitely the bank will or seal your house, or definitely the sold or your property, whatever the things you want to take. Okay, that's called a mortgage. So I just want to take another example. For example, if you want to construct a house, okay, if you want to construct a house, you need a loan from a bank. So definitely you approach for a bank will provide also loan facility to you, provided he will take the property and the house as a mortgage, so that in case you default, bank will or take back your house or your property and sold in the open markets and take back the money. Okay, so that is very much important. So let's turn out what exactly the law and Indian Contract Act says about the mortgage. So let's go to the topic and I'll tell about what exactly the mortgage. So according to the Indian Contract Act, a Transfer of Property Act 1882, a mortgage is the transfer of an interest in specific immovable properties for the purpose of securing the payment of money, advance or to be the advance by the way of loan on existing or future debt, or performance of an engagement which may give rise to a pecuniary liability. It means that bank has to take your property in case your liability, you are unable to pay the money. Okay, and it is not the ownership of a bank. It is always remember, it is the interest or right of a bank. It means that whatever you property you show, in case of default, bank has a right or bank has the interest to take back the properties. Okay, so if you have other properties apart from the whatever you show as mortgage, bank don't have a right to take back. Okay, only the specified whatever you show as a property. Okay, so what do you call a bank and what do you call a person who has taken a loan? So definitely if you think about a bank is a mortgagee and the person who take a loan is mortgager. Okay, and the things that is taken, the money that is coming against the mortgage or against your house, that's called a mortgage money. Okay, what's you call a loan amount? That's a mortgage money. Okay, so this is all about mortgage, and I hope you understand the term of mortgage when you approach for a bank. Definitely, if you go on educational loans or if you go on home loans, the things who are taken as a right to the bank in case I default, that's called a mortgage. Okay, so now the thing is, people have a confusion about what exactly there is other terms mortgage. Yeah, I know about mortgage, but there is other terms which also associated with hypothecations, plays, as well as lien, right? So whenever think about a mortgage, we also think about hypothecations, we also think about liens, we also think about the hypothecations as well as the liens, also think about the place, right? So what about the hypothecations? So when you think about is a mortgage is movable, hypothecation nothing but it's an immobile property. It means that, for example, if you are a manufacturing company and you are going to a bank for production or for your manufacturing of a product or for your finished goods, for your like whatever I told you in the last class about the overdraft or the cash cycles. Okay, I suppose that you need a loan from a bank. So what the bank do, bank wants to keep the your working capital or whatever the things like finished good or product or manufacturing, but all are as a hypothecations. Okay, on the certain term, in case you are default, bank will take back all the money, bank will sold all the working capital into the market and all the markets and pay back all the monies. Okay, so that is the called and hypothecations. So now the another terms is called into mind, that is place. Place is same like a hypothecation, but here the one thing is coming to the mind, the positions. Okay, whenever think about the positions, position means maradhikar, right? The whatever my rights and what possesses me. Okay, so in case of your hypothecations, it is the same like a bank where you keep something as a, for example, if you want to take a gold loans, you will go to the bank and keep as gold and taken a loan from a bank, correct? So gold is called as place, correct? But the difference between a place and hypothecation is that the positions of yours is, in case of hypothecations, is positions is your with the borrower. It means if I borrow the money, I have the position, I have the right. In case of mortgage also I have a positions because the house was with me itself. Okay, I have the position. But in case of a hypothecation is also me, but in case of place it is not. It in case of place it put the position of the banker. Okay, because whenever you take in a loan from the gold, definitely you have to keep gold in the bank, right? That gold is called in positions and gold is positions by the bank. So that is a difference between a positions as well as that's a difference between a hypothecation as well as the place, correct? So that's something. So what are the example I just want to give? If you think about mortgage, definitely your home. If you think about plant and machinery that is attached to a earth or something, like your home is attached to a earth, right? That's called an mortgage. If you think about hypothecation, definitely you have inventory and goods for the working capital. If you think about place, definitely your shares and NSC or your mutual fund, all these things, because it is kept in the bank and for that purpose you take a loan from a bank, correct? So that is what exactly the difference between through. Okay, so what exactly bank do in case you keep all the three things? Definitely bank has to do like sold all the things in the open market in case you default. Okay, and in case of you default, if you're unable to pay the money, definitely bank will sold in the market. If you think about a bike, right? When you're going to purchase a bike, and it's basically immovable property and it is coming under hypothecation because it is possessed by you itself. So what happened if you take a bike, you're unable to pay the EMI or EMI loans to the bank, definitely bank will take your bike and sold into the markets and pay its money or pay its loan itself. Okay, so if you understand the three things, definitely you understand the exactly what is the meaning of all that difference. Okay, so that's all about the three things about it. And another things I just want to discuss is, okay, you remember there is another term is called collateral. Okay, so here another story starts. Okay, as I told that I went to a bank and asked for an educational loans. Bank asked me what are the movable properties or what are the unmovable properties you can give. I gave my home and home as well as the properties I have. Okay, but still the amount is not sufficient, or still the amount was sufficient, but bank wants to keep something on a margin. That's called an that's something a margin, that's called a collateral. Okay, so if you think about collateral, in my case, an education loan case, my father an accounts in a bank, correct? So he is an general person, so he is an I can say that he is taken as I have taken the loan on the basis of him. So, okay, so that's called an is a collateral on the basis of that. Okay, so that person is called a primary security. My father is a primary security and he's the guarantor. For example, if I'm unable to pay the loan, educational loan, my father is able to pay because he has a salary account on this bank, correct? So that's the thing. So if you I can give you another example of a thing. Definitely there is an, if you think that if you want to building in a house or construction in a house, you definitely take a loan from a bank. But what if that amount bank want to keep certain margin? Definitely what if bank will ask some immovable properties from you and apart from your movable property. Okay, that's called a collateral, and you can take it as a, if you have a business, you can keep it as a things. If you want something as shares, bond, debentures, or if you purchase something from the market, you can keep also these things. If you want fixed deposits, also you can keep. That's all our immovable properties, and you can keep this as a collateral. Okay, so that is important, that is main thing about collateral. So hope you understand the collateral is the extra or another secondary security which bank has to keep apart from your primary security. Primary security I'm telling about your mortgage, your place, or your hypothecations. Okay, so these are four terms you understand, and the last term is lien. Okay, you understand about the lien. Okay, so what about, many people ask me about if I take an loan against my fixed deposits, then what if it is under collateral or it is under place? So I just want to it is under collateral or it is on the hypothecation or it is on the place. So I just want to say that it is under the hypothecation, but hypothecation is not good in terms because here in the fixed deposit you got a regular rate of interest. Okay, though you are taking a loans, but you got a regular rate of interest on your fixed deposits. Okay, so that's an call that I can give a term is called lien. Okay, so you can if you want to take a if you want to take a loan in against your fixed deposit also called a lien. Okay, so hope you understand something from this video. So what exactly the lien, what exactly hypothecation, what exactly the mortgage, and what exactly the place I have defined on this video. Okay, so I hope you understand something from this video, and stay tuned for my further video. Thank you so much for watching it.